Welcome to the deep dive. Okay, let's unpack this. Amcor's latest results are out, and it's really all about that huge Berry Global acquisition.
Absolutely. Transformational is the word they keep using, and it seems fair.
Yeah, it really does. So today we're going to dig into those numbers, see how the integration's going, and figure out what their guidance tells us about the path ahead. We want to give you the key takeaways fast.
The transformational leap, fiscal 2025 earnings overview.
So the deal itself, the Berry Global acquisition, it closed April 30th, 2025. All stock.
Right.
And it feels like it immediately changed everything. Looking at that first quarter post-deal, Q4 ending June 30th, what were the headline numbers? Did they really pop?
Well, they certainly did. For Q4, net sales hit, $5,082 million. That's up a massive 43% in constant currency.
43%. Wow. And constant currency, just to remind everyone, that strips out the effect of, currency swings, right? So it's the underlying business change.
Yeah, exactly. Gives you a clear picture. And alongside that, adjusted EBIT, that's basically their core operating profit before interest and taxes, adjusted for any one-offs, right? They jumped 34% constant currency, $611 million.
Okay, so huge jumps, clearly showing that Berry impact right away. What about the full year picture then for fiscal 25?
Similar story, though the percentage growth is moderated because Berry wasn't in for the full year. Net sales hit $15,009 million, up 11% constant currency, and adjusted EBIT was $1,723 million, up 12% constant currency.
And what's fascinating, I guess, is seeing how that breaks down between their main segments. Flexibles first.
Yeah, Global Flexible Packaging Solutions saw sales up 18% constant currency for the year, and about $420 million of that increase came directly from the acquired Berry sales.
Okay.
And its EBIT climbed 11% with $50 million directly attributable to the acquired EBIT. So, a significant boost there, giving them much more scale.
Right, but the rigid packaging side, that was where the change was even more dramatic, wasn't it?
Absolutely. Just look at the numbers. Global Rigid Packaging Solutions net sales soared 121% constant currency. That was driven by about $1.1 billion in sales from Berry.
121%. Incredible.
And the adjusted EBIT for rigids, it jumped a massive 173% constant currency, with $150 million of that coming straight from the acquired EBIT.
So huge injections of revenue and profit into both main segments.
Exactly. It fundamentally changes their position, their scale, everything.
Okay, but here's something that might make you pause. Despite all that growth, the adjusted EPS, well, for Q4, it was 20.0 cents. That was actually down 5%. But for the full year, 71.2 cents, up 3%. So why the dip in Q4 EPS when sales and EBIT were booming? That seems odd.
Yeah, it's a really important point, and it does look counterintuitive at first glance. The key thing to remember is the consideration shares.
The shares issued to pay for Berry.
Exactly. Because it was an all-stock deal, they issued a lot of new Amcor shares to Berry's former shareholders. So the total number of shares outstanding went up significantly. So even though the total profit pie got much bigger, you're dividing it by more slices, basically. That's what pushed the per-share earnings down slightly just in that initial quarter, post-close.
Okay, that makes sense. It's an accounting effect of the deal structure, not a sign the business itself stumbled in Q4.
Precisely. It's not an operational issue. And look, their adjusted free cash flow for the full year, FY25, was $926 million. Right on target. And they still increased the annual dividend up to 51 cents per share. So, the underlying financial health looks strong. They're showing confidence.
Integration and motion building a stronger foundation.
Okay, so the numbers show the immediate impact. But making a merger this big actually work.
Right.
That's the real challenge. How's the integration going? It's only been, about 100 days?
Yeah, just over 100 days post-close. And, this is where it gets really interesting. They seem to be moving quite quickly.
Like what are the early signs?
Well, they've already removed over 200 duplicated roles. That's pretty fast action.
Yeah.
And they've actioned 5 site closures already, trying to streamline the combined footprint.
So not wasting any time on the cost side. Is it translating to the customer side yet? Are they seeing benefits there?
Apparently so. They mentioned customer feedback has been really positive, and they're actually seeing some early wins, cross-selling opportunities.
Oh, interesting. Like what?
The example they gave was legacy Amcor providing a specific type of lining, a membrane lining for coffee capsules that legacy Berry used to supply. So now the customer gets the whole solution from one place.
Okay. That's a tangible synergy right there.
Exactly. And they also mentioned they've validated their procurement pipeline, locking in some quick wins just from the combined purchasing power.
Makes sense. Now, the big number everyone watches with these deals is synergies. They reaffirmed the target, right? $650 million pre-tax by fiscal 28.
They did. Still aiming for that $650 million total by FY28. It's ambitious, no doubt.
Definitely. How much are they expecting near term, say in fiscal 26?
For FY26, the target is $260 million in pre-tax synergies.
Okay, $260 million next year. How does that break down? Is it mostly cost cutting?
Primarily, yes. About $240 million of that $260 million is expected to come from cost savings, mainly G&A, corporate overhead, admin roles, that sort of thing, and procurement savings.
Right.
And then the remaining $20 million is projected from financial items. So a very clear path laid out for year one.
Got it. And there was this other financial item flagged, a $133 million inventory step-up amortization.
Yeah.
Sounds technical. What was that about? Should we worry about that hitting future results?
Good question. No, that one's done and dusted. It was a one-time accounting adjustment required when you buy a company. Basically, you have to revalue the inventory you acquired to its fair market value at the time of the deal.
Okay.
That $133 million reflects that adjustment, and it was fully amortized, fully accounted for within fiscal year 2025. So it will not impact FY26 results.
Right, so just part of the purchase accounting, not an ongoing drag.
Exactly. Connects to the bigger picture of just getting the financial housekeeping done properly post-acquisition.
Navigating market dynamics and strategic optimization.
All right, so the acquisition drove massive headline growth. But underneath that, it seems the actual market demand wasn't quite as strong. Combined volumes in Q4 were down, 1.7% year over year?
That's right. And they specifically mentioned softness in North America.
So what's the story there? Was it losing customers?
Yep.
Destocking?
According to management, no. It wasn't market share loss or customers suddenly clearing out inventory. They put it down mostly to broader macroeconomic uncertainty, weaker consumer sentiment.
Okay.
And importantly, they said both legacy Amcor and legacy Berry saw pretty similar volume trends in their respective markets. So it sounds more like a general market slowdown than a company-specific issue.
So the growth we saw was really acquisition-driven, not market-driven.
Largely, yes.
Yeah.
That's the key takeaway on the volumes for Q4.
Now, one specific area they did flag as a challenge was the North American beverage business. Saw a $20 million earnings decline in Q4.
Yeah, that stood out. They pointed to operational inefficiencies, things like higher labor costs, higher freight costs, and not getting enough production through some of their bigger plants, which hurts cost absorption.
And those higher costs are expected to stick around into Q1 of 26 as well.
That's what they indicated, yes. So it's not a quick fix.
So what are they doing about it? This raises a question, doesn't it, about balancing these short-term fixes with the bigger strategic picture?
It absolutely does. Their immediate response has been to re-segment that business, basically pull it out so it gets direct management focus, put a dedicated team on it.
Okay.
And they said they're developing a detailed plan to tackle those inefficiencies. It shows they're aware and acting, but the results remain to be seen.
Right. Beyond fixing specific problems, they also did a wider strategic review of the whole portfolio, didn't they? Identified a $20 billion core.
Yes, a major portfolio review. They've defined this core as being focused on consumer packaging and dispensing, mainly for nutrition and health markets.
And what makes it core?
Well, about 3/4 of it is in what they call innovative advanced solutions. And roughly half is in categories they see as high growth and high margin. Think healthcare, beauty, pet food, food service, liquids, protein, those kinds of areas.
So focusing firepower in the most promising segments.
Exactly. Leveraging their new scale and combined capabilities in those areas.
And the flip side, were there businesses that didn't make the core cut?
There were. They identified about $2.5 billion in annual sales coming from businesses deemed less aligned.
Okay, $2.5 billion. What's in that bucket?
Well, notably, it includes that $1.5 billion North American beverage business we just talked about.
Ah, interesting. So it's not just an operational issue. It's maybe strategically less core, too.
Seems that way. And then there's about another $1 billion from various other smaller businesses that don't quite fit the new focus.
And the plan for these? Optimize or sell?
Optimize or potentially divest, yes. The goal is clearly to sharpen focus on the core, drive faster organic growth there. They didn't give a firm timeline for divestments, but suggested some progress on the smaller pieces might happen in fiscal 26.
Okay, so strategic trimming alongside the integration effort.
The path forward, fiscal 2026 outlook.
All right, let's turn to the future then. The guidance for fiscal 2026. This is really where we see their priorities crystallized, right? What's the main EPS guidance?
Okay, so for adjusted EPS in FY26, they're guiding for 80 to 83 cents per share.
80 to 83 cents. Compared to the 71.2 cents in FY25, that's pretty strong growth.
It is. It represents 12% to 17% growth on a constant currency basis. A really solid outlook.
And what's driving that growth? Are they expecting markets to suddenly bounce back?
Crucially, no. They were very clear about this, that strong EPS growth is expected to be driven primarily by synergy realization, getting those cost savings and efficiencies from the Berry deal. They're assuming market volumes will remain broadly flat. So this is very much a self-help story for FY26. They're not banking on external market improvement to hit these numbers.
That feels prudent, given the uncertainty we talked about, relying on what they can control.
Exactly. It's about executing the integration and delivering those promised synergies.
What about cash flow? That was strong in 25. What's the outlook for 26?
Even stronger. The guidance for adjusted free cash flow is expected to basically double.
Double, really?
Yeah, they're guiding for $1.8 billion to $1.9 billion in free cash flow for FY26.
Wow. And that's after paying for integration costs.
That's right. Even after deducting about $220 million, they expect to spend on integration and transaction costs next year. It really shows the cash generation power of the combined entity once synergies kick in.
That's a huge number. Any other key financial guideposts for 26? CapEx, interest.
Yep, they gave guidance on those too. Capital expenditure expected between $550 and $900 million. Net interest expense between $570 and $600 million reflects the debt taken on. And an effective tax rate projected between 19% and 21%.
Okay, provides a good framework. Now, about that debt, where does it stand now and what's the plan?
Right now, their net debt is sitting at around 3.5 times EBITDA, which is, elevated because of the acquisition.
Sure.
Their plan is to get that down pretty quickly. They expect to reduce it to around 3.1 to 3.2 times by the end of fiscal 26, so by next June.
In the longer-term target?
The target range is 2.5 to 3.0 times EBITDA, which is typically considered solid investment-grade territory.
So deleveraging is the top priority for that massive free cash flow then, before things like buybacks or more M&A?
Absolutely. They made that clear. Deleveraging comes first. Once they're comfortably within that target leverage range, then they'll look at potentially returning more cash via buybacks or considering smaller bolt-on acquisitions. But step one is strengthening the balance sheet.
Makes sense.
And one other interesting point on strategy, they see a real opportunity to apply Amcor's legacy value-based pricing approach across the legacy Berry portfolio.
Yeah.
So potential for commercial synergies there too, not just cost-cutting. Outro.
Okay, so pulling it all together. The Berry deal really was transformational. The FY25 numbers show the immediate scale impact, and the FY26 guidance looks strong, pointing to significant earnings and especially cash flow growth.
Yeah, and the key theme seems to be that this growth, for next year at least, is largely internally driven. It's about making the merger work, capturing synergies, optimizing the portfolio. It's a self-help story.
Not relying on the market to lift them up.
Exactly. Which leads maybe to a final thought for you, our listener.
Go for it.
What does this intense focus we're seeing here on self-help, on internal efficiencies, on strategic portfolio choices, what does it tell us about how companies generally are trying to navigate these really uncertain economic times? Is this internal focus becoming the main way to find consistent growth when the external environment is so choppy?
That's a great question to ponder. Are internal efficiencies the new growth frontier? Okay, we've taken our deep dive into Amcor's latest. We hope you feel even more well-informed. Until next time.